Okay, we really need to talk about what's going on with the U.S. housing market in early 2026, because it's a genuine head-scratcher. I mean, by all accounts, it should be struggling right now. But the data? Well, it's telling a completely different and, honestly, a much more confusing story.
And that right there, that's the central puzzle we're going to unpack. You've got a world that feels pretty chaotic, but at the same time, a housing market that seems to be completely defying gravity. So, how is that even possible? Let's just look at the context for a second.
Just think about the headlines you've been seeing. We've got major AI disruptions making everyone nervous about job security. We've had these historic snowstorms that have literally paralyzed entire parts of the country. And of course, a serious international conflict is creating a ton of uncertainty everywhere. None of these things exactly scream, hey, now's a great time to buy a house.
But even with all of that as a backdrop, the data shows demand is still growing year over year. It's this incredible paradox. So what is the secret force that's holding this entire market up? Let's find out.
You know, to really get what's happening, you have to know the market's secret code. And it turns out, there is one specific number, a critical tipping point, that has basically dictated which way housing demand goes for the last few years.
And here it is, 6.64%. Go ahead and burn that number into your brain, because this single mortgage rate has been the key. You could call it the market's magic number, and it's what unlocks this whole puzzle.
The rule itself is actually incredibly simple. When mortgage rates dip below this magic number, demand just consistently rises. But the second they push above it and start heading towards 7%, demand falls off a cliff. It really is like a light switch for the entire market. And hey, this isn't just some new thing. We've seen this exact same pattern play out again and again. It happened in late 2022, it happened in mid-2024, and then again in mid-2025. Every single time rates dropped below that threshold, buyers came rushing back. So this 6.64% rule, it's got some serious credibility.
All right, so if we know that's the rule, where are we right now? Well, the market is sitting right on that knife's edge. And the forward-looking data, the stuff that tells us where we're going, shows we're at a really critical inflection point. Okay, so our first indicator is what's called pending home sales. The best way to think about this is like a sneak peek into the future. These are the contracts that have just been signed, so they tell us what the official sales numbers are probably going to look like in a month or two.
So when you look at the raw numbers, you can see we're still technically ahead of last year. But, and this is the key detail, the rate of that growth has slowed way down. The market's momentum is definitely starting to sputter.
Now, our second clue is even more forward-looking: mortgage purchase applications. This is like the very first step for a ton of buyers, and it happens up to 3 months before a sale actually closes. So for us, it's our earliest possible warning system.
And here, the slowdown is it's dramatic. We were seeing really strong growth not too long ago, up around 12% year over year. Last week, that plummeted to just 5%. That is a major cooling off. It's pretty clear that higher mortgage rates are finally starting to bite.
So, to put it all together, while we haven't slammed on the brakes and gone into a full stall, the rockets that were pushing this market higher, they're definitely losing some thrust. The market's surprising resilience is finally really being tested. And this brings us right to the central tension in today's market. What we're seeing is basically a massive tug-of-war with two extremely powerful forces pulling mortgage rates in completely opposite directions.
So on one side of the rope, you've got the bad news. All this global instability, especially the conflict in Iran, it makes investors really nervous. And when investors are nervous, they demand higher returns, which pushes up bond yields, and, in turn, pushes up our mortgage rates.
You can see the impact crystal clear right here in the 10-year Treasury yield. I mean, before the conflict really escalated, it was hanging out below 4%. Now, it shot up to around 4.44%, which is already getting really close to the peak that was forecasted for the entire year. That's a huge move, and it's driven almost entirely by geopolitics.
But that is not the whole story. Because on the other side of this tug-of-war, there is an incredibly powerful positive force at play, kind of working in the background. And it's something called the mortgage spread.
So what in the world is a mortgage spread? Well, the easiest way to think about it is as the lender's markup. It's just the gap between that baseline 10-year Treasury yield and the final mortgage rate that you actually pay. And here's the key. When that gap shrinks, it's a huge benefit for homebuyers, even if the Treasury yield itself is on the rise.
And honestly, the recent improvement in these spreads has been nothing short of a market saver.
To really get your head around just how important this buffer is, let's just run a quick what-if scenario.
Okay, just walk through this with me. Today's actual rate is 6.64%. But if we were using last year's spreads, right now, that rate would be 7.18%. What if we had 2024 spreads? It jumps to 7.37%. And if we had the really wide spreads we saw back in 2023, today's mortgage rate would be a staggering 7.75%.
Yeah, just let that sink in for a second. The only thing standing between the current market and a rate environment that would absolutely crush demand is this improvement in mortgage spreads. It is the market's hidden hero right now.
So where does all of this leave us? Let's pull it all together and give the final verdict on this incredibly complex, incredibly fragile market.
Here it is. This is the balance of the market as it stands today. On one side, pulling demand up, you've got that critical buffer from the improving mortgage spreads and some buyer interest that's still hanging on. But on the other side, pulling demand down, you have those rising global tensions and our leading indicators that are all flashing yellow. The market is perfectly and very, very fragilely balanced.
And that leaves us with the billion-dollar question for the weeks ahead. We've got major jobs data coming out soon, which tells us about the health of our own economy, and we have this ongoing global conflict, which represents global risk. So which one of these powerful forces is going to win the tug of war and set the direction for housing for the rest of the year? Well, we are definitely going to be watching.